What I'm getting at is, are you still strongly believing that $300 to $500 range is possible here
Yeah,
soon?
well, let's just look back, for example, at the 50-year range silver's been in between $5 on the bottom side and $50 on the high side, back and forth for 50 years. In November, we put out our last long-term buy signal, priced in 56, just barely above the range highs, and said, okay, we're now entering the massive acceleration phase in silver. There will be a correction somewhere in the middle, not necessarily in middle of price or middle of the clock necessarily, but somewhere in this process of going to 300 to 500. You're going to find a correction. It'll probably, scare people.
Silver and gold are making headlines once again, but not for the reasons most mainstream analysts will tell you. While paper markets show volatility and confusion, the underlying technical and physical signals point to something far more significant brewing beneath the surface. Andy Schectman, president and CEO of Miles Franklin Precious Metals, sits down with Michael Oliver, founder of Momentum Structural Analysis MSA, explained that the real story is not random market noise, but a decades-long structural breakout in silver, one that mirrors what copper and lead did before their explosive price revaluations, and a gold market that remains in a congestion zone that is closer to resolution than most realize. Together, they break down what the 50-year silver range really means, what history tells us about prices once they escape long-term trading bands, and why the much-talked-about $300 to $500 silver target is not only still valid, but arguably inevitable. Now, we present the clips from Andy Schectman and Michael Oliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Michael, I've followed you for a long time, and your track record is fantastic. I can remember many walks during the pandemic, living in Minnesota, bundled up, walking this long walk that I had, listening to things you were saying that have been remarkably accurate. And I think you know where I'm going with this one. I can't let you off the hook because you've written that your longer-term target zone for silver remains between 300 and 500. Man, I've talked a lot about this on my podcast. It's a glimmer of hope for all of us who have held strong fingertips, held on to silver. And you say that it breaks through this level once it breaks free from this prolonged congestion pattern you just mentioned. For those people who believe that such a move sounds impossible, what lessons does market history offer about how quickly prices can reveal or revalue once a market escapes this long-term trading range and enters a true price discovery phase? What I'm getting at is, are you still strongly believing that $300 to $500 range is possible here soon?
Well, let's just look back, for example, at the 50-year range silver's been in between $5 on the bottom side and $50 on the high side, back and forth for 50 years. Okay. And back in early 24, when prices of silver was coming up to $25, it had already been at 30 in 2020. But in 24, it came back up to 25 again, approaching the top end of that zone. And we said, okay, you're going to start to gush now. And once it got up to 35, we found some resistance there, not at the $50 level again, at 35. It prevailed for several quarters. And the third attempt to get back up there, 35 one time, 35 another, and then the third attempt, we said this time it's going to take hold and gush. Well, we went up and blew out the all-time highs at that point. And in November, we put out our last long-term buy signal, priced in 56, just barely above the range highs, and said, okay, we're now entering the massive acceleration phase in silver. There will be a correction somewhere in the middle, not necessarily in middle of price or middle of the clock necessarily, but somewhere in this process of going to 300 to 500. You're going to find a correction. It'll probably, scare people. We didn't call the top at 120. It came in literally 1.5 days. You dropped from 120 to 64. Okay, so it was hard to call. But we still assess it as a correction in the middle. But our assessment now is using some historical archives. Copper did the same thing that silver's been doing. For many decades, it was caught between 50 cents and $1.50, just asleep, decades. Late 2005, It finally ate its way up through the $1.50 ceiling. And within several quarters, with a correction in the middle, it reached $4.10. Boom, off the page vertical. And then lived in a new reality for the next decades, an average price of about $3 to $3.50 as opposed to an average price of $1. Okay. And now, of course, it's $6.30. Okay. So it continues on. Lead did the exact same thing in 2010, not in sync with copper, but on its own, without headlines. It had a range that prevailed for multiple decades. And when it took it out with a jiggle in the middle, it quadrupled in price in several quarters. Okay. A new reality. Okay. Now, okay, if silver did that, what those guys did, when you look at a price chart of lead or price chart of copper and put it on an arithmetic scale or a logarithmic scale, two different types of charts, put it on an arithmetic scale, it went way past a simple doubling of the range, which is 50 cents to $1.50. That's $1. So you go to 250 would be to $1 above there. Okay. Instead, it went to 410, where you put it on a logarithmic or ratio scale. It doubled the thickness of the range. 50 to $1.50, you got to $4.10 quickly. Lead did the same thing. Logarithmic scale doubled the thickness of the range. If silver range is a tenfold, let's call it $5 lows to 50, 5 to 50, tenfold dimension between the two. Tenfold above 50 is what? Okay.
500.
The conversation digs deep into the technical methodology behind MSA's long-term silver target of $300 to $500. Drawing on the historical precedents of copper and lead commodities that traded in tight multi-decade ranges before breaking out explosively, the analysis shows that once silver fully escapes its 50-year band of roughly $5 to $50, the logarithmic projection points squarely to a tenfold move above the top of that range. A mid-cycle correction already appears to have occurred, with silver briefly touching $120 before pulling back to the $64 range, yet price remains essentially sideways from that first drop, which itself is a bullish signal, not a bearish one. Meanwhile, on the gold side, the breakdown below the 200-day moving average is dismissed as technically irrelevant. No structure has been set at that level. The key signal to watch remains the 50-day momentum, which has acted as a ceiling twice, and once reclaimed, would confirm the next major leg higher. Now, let's get back to the interview.
I agree with their fundamental view, the contrarian view, because the technicals argue, no, be very cautious about believing, like so many do, that it's over. That we're gold's going to 3,500 and silver to 50 or something, be very careful about that. Huge
there are a lot of people saying that too.
Oh yeah, a lot of people. I'd say the vast majority are saying that. Yes.
Turning specifically to gold, Michael, you've noted that gold remains below its key 50-day momentum level. I think you called that pounding on the table level, and it's now, as of yesterday, slipped below its 200-day moving average as well. How significant is that development? Is the market, in your opinion, saying not yet? Or do you see something more concerning beginning to emerge in terms of both of these numbers being violated?
We're aware of a lot of moving averages, and we think they're essentially, most of the time, irrelevant. In other words, crossovers of the 200-day or the 50-day, sometimes they're noise. More often they're noise than not, meaning they confuse people. Gold has not set structure at the 200-day, meaning had gold gone down to the 200-day once a year or two ago, and then another time it held the 200-day, and then the third time you broke through it, that's a structural break. But just to weave through an average that it hasn't seen in eons, is not meaningful. Now, in the case of the 50-day, we're very keen on it because, you're below it, and that's irrelevant too. But the question is what you've developed on structure. When you look at a 50-day average momentum chart, you'll see that once we broke below it a couple months ago, we've come up to it and been knocked down again, come up to it again, knocked down again. You go back a third time and cross that 50-day to the upside, it's now structurally important as a positive signal, meaning you have set the structure twice as a ceiling on momentum. You cannot see a flat structure on price. You could see it on momentum. You get back above that 50-day again, and that's about our final signal that this congestion zone, violent up-down congestion zone that we've seen since January 31st, okay, is ending, and we're going up, okay. There have been other rallies within this 5.5-month zone that didn't sustain. You get back above that 50-day again, it's going to sustain. And that 50 days coming down every day because the market's been coming down. So, yeah, we watch certain averages, but the 200-day crossover, I was aware of that. I think a couple of days ago we broke it. It's not technically important because there's no structure on momentum at the 200-day.
I've heard you talk about something that I've been talking about for a little while, too, and that is that the chief investment officer of Morgan Stanley said the 60-40 rule is now dead. Sell half of your bonds, put 20% of your assets in precious metals. The lead analyst of Bank of America, Michael Hartnett, saying the same thing. In fact, he says 25%. Jeffrey Gundlach, the bond king, 25% of your assets in metals is not too much, he says. BlackRock just said the same thing, 60-40 dead. We're going to go heavy with half of our bond portfolio sold and move into commodities, largely gold. My point to you is this. I want to get your opinion. I have an account with Morgan Stanley, and my broker is a good friend of mine. He's in the Forbes top 40 list. He manages $4 billion. He wouldn't know a gold coin if it fell on his foot. I said, you do know that your chief analyst, the guy that's speaking to the institutionals, just like Michael Hartnett speaking to the institutionals, his newsletter's thousands of dollars a month. I said, are you aware that your chief investment officer said sell half of the bonds? And yeah, in essence, even someone up at that level has no idea what their CIO is saying to the upper strata. Now, I frame it that way because as the price has been coming down so far in the month of June, 2.9 million ounces of gold have already stood for delivery, with another 289,000 ounces still open interest until the end of the contract, while roughly 1 million ounces have left COMEX, the vaulting system, over the past month, just got up and left. So, all of this money, 2.9 million ounces is over $12 billion worth of metal has stood for delivery this month. 4+ billion have left the system. Yet, despite the apparent physical demand, the paper price keeps getting pushed lower from a momentum perspective. Is this important? Is this divergence important? Is the physical market quietly signaling strength while the paper market continues to project weakness, I guess is what I'm saying. Is that important to your thesis?
That could be, but we don't measure that. But what we do measure is various timescales of momentum measurement. A lot of people look at daily action, weekly action. Well, sometimes we look at that too. Especially in relation to the 50-day average that I mentioned. You get above that on a daily basis, that's technically important. But the key issue now is that when we look at something like an intermediate metric like 3-month moving average, which is not a long-term, but it's, usually when it shifts trend, it'll go for 4, 5, maybe 6 months in one direction. The momentum readings will. Now, what's so funny is when you look at gold on a monthly oscillator, you made your peak in January. Okay. 6 months of declining highs. 6 months. Okay. You'd say, well, they must have absolutely killed gold. Well, if you go back to the first down month, January, the low in gold was 4,400. Okay. It's 6 months later, Jan, Feb, March, in 6 months inclusive. Where are we trading? A couple $100 below there. We've been just above there. And we're still above the March low. Not that it technically matters whether you'd hold it or not. But the point is, it's been sideways. Silver, same story. It's low in January, February, first drop, $64. Where are we trading right now? So we speak 64.50 or so.
It's the same. It's that sawtooth. It's the
6
volatility.
months momentum down, and yet net price sideways from that first drop. So I would say, okay, if you're bearish, unless you were absolute genius and sold $100 and $120 silver, but more likely you sold it in the 90s or 80s or 70s even, and got out of your position, you've been kissing your sister for 6 months. It's okay. Let's see it. Let's see it then. And we argued in the weekend report. We said that, okay, you better do it now, like this week. You bears better collapse these beasts. Because if you just keep ratcheting little tiny ratchets every day, like silver's down $3, $4, $4 on the week right now or something, and all of a sudden you flip back up, it's over. You've had your clock. You've had they just rang the bell. It's the other guy's turn. Okay. So now either MSA is wrong and we're actually going to have a massive, not a correction, that's a collapse. You go down to the 50s, which that's a uniform chorus right now. Even among gold bulls, got to go to the 50s. And gold's probably going to 3,500. Well, we'll be wrong if it goes there.
What this interview makes abundantly clear is that we are living through a rare, once-in-a-generation transition in the precious metals market, one that most retail investors and even professional money managers are not yet fully positioned for. The fact that major institutions like Morgan Stanley, Bank of America, BlackRock, and Bond King Jeffrey Gundlach are publicly declaring the death of the 60-40 portfolio and recommending 20 to 25% allocations to precious metals is no coincidence. It is an institutional acknowledgement of what sound money advocates have been saying for years. For silver holders who have endured the long, frustrating wait inside that $5 to $50 band, the message is simple: the breakout has already happened. The correction in the middle was painful but characteristic of every major commodity repricing event in history. The bears have had months to collapse the market, yet they have failed to do so in any meaningful way. The price remains remarkably resilient. History, whether it's copper in 2005 or lead in 2010, shows that once these structural escapes take hold, prices move to entirely new realities quickly, and without looking back. The window to accumulate at these levels may be narrower than most people think. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.